It's Naganath, President and CIO of DSP BlackRock Investment Managers, a veteran of the markets, joins us to answer these and other questions. He's our market master for the day. Good morning, Naganath. Pleasure having you with us in the studio on crucial moments for the market, crucial days for the market. What is your sense? Has the budget unleashed enough disappointment for the markets now to correct a great deal? Or is this a normal correction after a run-up from 6,200 to 7,800? This actually affords an opportunity to buy.
Well, first of all, I think the budget is a pragmatic budget. It lays out a roadmap for fiscal consolidation. It has several measures in place for reviving growth and manufacturing in particular. And my sense is that even though this year you will see growth somewhere in the 5.5%, 5.75% range as has been projected, what I'm looking forward to is growth picking up to about 7% for the next fiscal year. And I think we will see that trend, is my opinion. And as far as the correction is concerned, I think it's partly because the market has done very well in the last few months. There are external factors at play now. We have to be cognizant of the fact that geopolitics is increasingly a risk now, especially with regard to oil prices. The banking issues in the Eurozone, I think, also need to be watched carefully. So if there has been risk aversion in the last week or so globally, it has been because of principally these two events, which obviously has had a ripple effect on equity markets around the world. So let's not mix up the two together. It may well be that the markets around the world continue to trend down, and so will our markets. But I would not attribute it to...
that as a possibility?
Yes, I think so.
Okay.
Near term at least.
Okay. The global market's correcting significantly.
Yes. Significantly could be another 5-10% possibly, yes.
Okay, that's not too much in the context of how much the markets have rallied already.
Yes.
But do you think for the rest of the year at least, the best of the news flow and the price performance for our markets is behind us?
No, I would not say that. I think as far as news flow is concerned, I think you should expect more policy decisions in the coming months or so. And certainly more specifics in the next budget, if that is a disappointment of people, the fact is there was paucity of time. So as far as I'm concerned, the broad roadmap for fiscal consolidation is there, which is welcome. Initiatives aimed at improving growth is welcome. And to my mind, while we need not be too obsessed with the fiscal deficit number, a roadmap is good enough for me as an investor. What is more important is to see growth reviving, which I'm confident we will see.
Yeah, actually, what stood out in your first answer, and I wanted to take you up on that, 7% GDP next fiscal, you said. Are you expecting earnings upgrade in FY15 itself? Therefore, what kind of earnings growth for FY15, 16 would you pencil in?
Right, so even if it is around the 14-15% for this year,
you would think that is deliverable, 14 to 15.
Yeah, you could well see that. Maybe it's a little back-ended for this fiscal year. Okay. But my sense is once growth ratchets up to 7%, and the rationale for that delta between 5.5 and 7 is simply the revival of investment spending, capex spending, all of which I believe is possible 6 to 9 months down the road. I think earnings growth could easily get closer to the 20% mark.
Okay,
and then hold steady for another year or so before it sort of averages out somewhere in the 17-18%, which has been a long-term trend that we've seen in the past.
This 20% is for FY16?
FY16 and FY17, both years I'm expecting. Because once you have momentum, I think you will see that sustaining.
Okay. Well, on Friday, there was some confusion over, clarity on GAR, etc. And that kind of saw investors a bit nervous. But the Revenue Secretary then clarified that the government will take a view on GAR post, April 1st.
Yeah.
So, do you think that has soothed nerves, or would you still be concerned about the lack of clarity on GAR?
Well, I mean, I have as much knowledge about it as I read in the newspapers. And my sense is, it was a non-issue in the sense they have mentioned that they have not even looked at it this time around. So the previous situation was that it would take effect from April 1, 2015. If that is where it is today, I don't see why anybody should be worried about it just yet.
Okay, but if it is indeed clarified that it will stay, as with retroactive taxes, the finance minister didn't remove any of the ambiguities and in fact didn't hold out much in terms of hope as well. He actually reiterated the supreme power of parliament to enact retroactive taxes. As well, a committee is set up for scaled up cases of retroactive tax applications. That's not saying much at all according to the tax experts and corporates we spoke with. Now, I'm just asking if these two can in any way scare away investors.
let's look at these two issues separately. Let's not mix up the two.
Okay, sure.
Retrospective taxation has to do with certain companies. I don't have enough facts to comment intelligently on that. So, to my mind, as far as the marketplace is concerned, the focus is more on GAR, etc.
Okay.
Now, even there, the fact is, if it is going to effectively happen from April next year, and there'll be clarifications hopefully coming up, the fact is, if you're in a growth mode and your markets are doing well, investors are going to overlook that and say, we have to invest. Nobody's going to say, oh, there is GAR, therefore, we are not going to invest or invest less. So let's not give it too much importance, more importance than is deserved, is my opinion.
Okay. So if you have to lay out, some sort of roadmap for us in terms of how the index could progress in the next couple of years, what do you say could be the base case and the best case scenario?
Well, it's always difficult to guess where the index will be, but let me try nevertheless. I think in the near term, like I said, geopolitics will cause a bit of risk aversion globally. So our markets, like many other, like the Western markets have also done very well. Our markets have done really well in the last few months. We could see a bit of a correction, a mild correction. That, to my mind, would be a great buying opportunity for medium and long-term investors. That's point number one. And I would still say that as growth begins to ratchet up, you could still see the potential for another 20% upside between now and, say, 1 year from now. And I do think that if we do get to the 7% growth rate in fiscal 16 and 17 with 20% earnings growth, I'm confident of that. I think we could well see the index double from here in 3 years' time.
That's saying a lot. Actually, there was a money control question. I wonder why we're not able to get that up. I was expecting that to come up. Our money control borders, our website borders can ask you questions. And I thought one of the questions I saw in the list was about, whether it can get back to that 8,100 mark that people were talking about this year itself. That question will come up.
That's a very modest expectation. It's only...
no, they're expecting it this year.
Oh, this year. Okay. Well, I would say within the next 12 months, I think I still expect more policy decisions aimed at reviving growth. And, the budget is not the only forum for announcing policy decisions. I think we should expect that through the course of this year and into next budget in February.
Well, Naganath, over the years I've heard you, and you're normally a cautious man.
Yes.
So what you're saying today is really music to my ears, that in 3 years you wouldn't even be surprised if the index doubled. Okay, for the shorter term, because ultimately life has to be measured in days and weeks as well.
Okay.
Do you think it would be a good idea to get into IT stocks, or precisely, that should be avoided and you should have cyclicals when the market gives you the opportunity?
Well, I'm presuming you're talking about an investor who has diversification represented in the portfolio. So to that extent, perhaps a bit more of technology and pharma at this point may help near-term performance. But I would still argue that if you take a 1 to 3 year view, banking and financial services, which has a high weightage in any bellwether index here, ought to be a preferred sector. It has done very well. It may see some correction as we've seen in the last few days. But medium term, long term, I think it will do very well. Likewise, the infrastructure, capital goods, engineering sectors, which saw some fairly good movement and has seen some correction now. Again, if one does expect, like I do, a revival of growth and manufacturing and all of that, I think that sector will also do very well. Not to say that IT and pharma will underperform. IT is doing very well right now, and growth is going to be good. So I think a judicious mix of all these sectors in one's portfolio, with some tactical changes periodically, I think will serve the investor well.
It's nice to hear such an optimistic tone at the start of the week. I would love to be around in 2017 when the Sensex touches 50,000.
Be our stock market editor.
Who wouldn't like to see the Sensex at 50,000? But in any case, you spoke about most sectors. What about mid-caps? Because, the fall that we've seen in the last couple of weeks has rattled some people.
Okay.
Would you use that as an opportunity? And if yes, what are the specific pockets?
And just since you would perhaps answer it in the same vein, what kind of lows can we see? Do we see, the technical guys tell us 7,200 is a fairly big technical support. Would you worry if it went below that? And what kind of falls are you expecting?
Well, first of all, the issue I have with many investors is, you often look at mid caps, the generic, that is, if this is done well, this should do well. It's not like all mid caps are going to do well just because there is a flare up in the mid cap index. So whether you buy mid cap funds, you buy mid cap stocks, be careful in what you choose. They certainly do very well when the momentum is good, better than the large caps. Same is true of the small caps. Equally, when there's a market correction, they do decline quite significantly. So it may well be that the large caps lose a bit of ground due to global risk aversion, mid caps do even worse, and so do small caps. But if you do have confidence in your stock picks, by all means, you should be looking to buy more and hold it for the medium to long term. So I think a generic approach may not be the appropriate one. If you have confidence in the fundamentals of your mid-cap and small-cap stocks, hold on to them, buy more if they fall further, would be my advice.
Okay. Well, actually, before we let you go, an important question from a fund point of view.
Yes.
FMP is dead because of the non-equity funds getting taxed 20%?
Yeah, I think the budget provisions for non-equity oriented funds in terms of taxation was not expected. So to that extent, there is a bit of concern that that whole segment, may not see any growth at all, or in fact, FMPs, like you said, may not be popular at all. One is hoping that there'll be some clarification there, at least that if it says it will be applicable only to closed-ended funds and not to all other open-ended non-equity funds, I think that might be...
Actually, it's applicable retroactively as well. From April 1st, 2014, we are told. Could you get any clarification on that?
No, I have not had any insight into that, whether it is applicable retroactively. I saw a ticker on your channel yesterday which said that there would be no retrospectivity or something like that. Okay. So I'm not clear as to whether it applies from April 1 or prospectively.
Okay, but you would still say that debt funds have a chance for investors. Debt funds where you stay on for 3 years, 36 months is still an investment opportunity, or FDs are better?
Well, definitely. I think, if you do have that 3-year plus time frame, I think, and then you pay tax at the rate of 20% with indexation, I would still say it will compare quite nicely when you compare it with FDs.
Okay. Just one final comment. I know you don't comment on individual stocks, but this morning, Infosys is down 3.5%, despite delivering what looked like a better set of numbers. How do you approach this stock now?
Well, I cannot comment on individual stocks, but I would argue that, any decline, like I said, late last week and maybe this week, one will generally attribute it to some profit-taking plus risk aversion globally.
All right, Mr. Naganath, thank you very much for joining us. Pleasure hearing you out, and especially because you have such an optimistic view at a time when the market appeared to be selling off, and there were headlines that this is the worst week in 15 months, we were told.
Thank you again.
Pleasure speaking with you.